Welcome back, Alpha Hunters. In this video, I'm going to break down the Condor and the Iron Condor options order. And we are going to start by putting one together using the options strategy template. And then I will give my thoughts on the order and why this is one of my favorite orders and I use it often. And then to wrap things up, I'll show off some risk profile charts in thinkorswim. So let's get it going by using the options strategy template to understand how a condor is put together. So in many instances, the condor is very similar to the butterfly if you understand how the butterfly and it is put together and utilized. As you can have a sideways condor or you can have an up and down condor where you want the stock to move outside of that range. And the sideways condor is going to be constructed by using a bull vertical on the lower leg and a bear vertical on the upper leg. And then for the condor that you want the stock to go up or down, you just want to reverse the bull and bear verticals. You want the bull vertical to be on top and the bear vertical to be on bottom. But you will notice the difference between a butterfly and using a condor is the strikes are different. With the butterfly, the middle strike will overlap, but in the condor, no strikes are overlapping. They are all different. So let's begin by breaking down the sideways condor. So you will have the bear vertical on top and a bull vertical on bottom. The cash flow will depend on which kind of verticals you use. Are you using mostly credit verticals or are you using mostly debit verticals? So it just kind of depends on how you construct your condor or iron condor. Now the loss on a sideways condor is going to be anything outside the break-even points. Okay, and to find the break-even points, if we have a debit condor, it's going to be the outside strikes to the inside with the premium. Or if it's a credit condor, we're going to have inside strikes to the outside with the premium. And then anything in between the break-even points is going to be our profit. And for the condor that we want for the stock to move outside of a given range, whether it's bullish or bearish, we will use a bull vertical on top and a bear vertical on bottom. Okay, and the cash flow, again, will depend on which kind of verticals we're using. And the loss in this instance, obviously, is going to be anything in between the break-even points. And this time, the break-even points are going to be a little bit switched with the debit and credit. For a debit transaction, it's going to be inside strikes to outside with the premium. And then for the credit, it's going to be outside strikes to inside with the premium. And then anything outside the break-even points is going to be our profit. Now let me give you my thoughts on the Condor and Iron Condor. So you're going to have many choices to set up a trade. Okay, there's no lack of choices on how you want to set up the trade. So if there's too many choices and you don't understand all of them, don't worry about it. Just stick with what you know, what you can understand. And the risk reward will be pretty much the same. Whether you can do Iron Condor or Condor, it's not really a big deal. And all Iron Condor means is you have a mixture of calls and puts. But a Condor is just using all calls or all puts. So if you understand that way better, that's fine. The risk reward is not going to be any different. And this is going to be great for delta or theta plays. So obviously for the theta play, we want it to stay range bound. Delta, we want it to move outside of that given range. And this is going to be easy when the stock is unpredictably volatile, just like the butterfly, or when a stock is going to be predictably range bound. And the Condor also provides excellent reward to risk to probability of outcome. Okay, and probability of outcome is something that I don't see too many people talk about, and I will make another video about probability of outcome and why that is crucial in setting up your trade setups with reward to risk. And to wrap it up, this is a great strategy to use often, and it's definitely one of my favorite strategies to use. And the reason for that is I love using the range-bound Condor or Iron Condor. And I mostly use Iron Condor when I use range-bound stuff. So let's look at a couple strategies real quick and see if we can help understand how we can use these strategies. So we'll say we got a stock at 185, and we're going to use a Condor setup with the expectations the stock is going to go up or down. And we will use strikes 175, 180, 190, and 195. Now you'll notice that there's not a strike at 185 because that's where the stock is. We're just going to push it 5 points away from the stock and we'll start the spreads there. And we'll use a bull put vertical and a bear put vertical. So obviously this is going to be a traditional Condor setup since we are using all puts. And the value for the puts at 175 are going to be at 8. At 180 they're going to be at 10. At 190, 17. 195 at 20. So obviously the 190 and the 195, these two strikes are in the money, and the 175 and the 180 are out of the money. So how we can figure out our premium is the bull put vertical will produce a credit of 3, the bear put vertical will produce a debit of 2, and we will get a net premium of a credit of 1. We can now use that net premium to calculate our break-even points. We'll take that 175 strike, we'll add the credit of 1, and we will get a 176 lower break-even. We will then take the higher strike of 195 and subtract the credit of 1 to get a higher break-even of 194. And then anything between those two break-even points is going to be our loss, and anything outside of those break-even points is going to be our profit. Let's look at another example real quick, and we'll have a stock of 145, and we're expecting it to stay somewhat range-bound or sideways. So we'll use strikes 130, 135, 160, and 165. And we're going to use a bear call vertical and a bull put vertical. And you notice right away, since we're using calls and puts, this is what's known as an iron condor. Another thing you'll notice is that we are not perfectly balanced away from the 145 strike. So the 160 strike is 15 points away from 145, and the 135 strike is 10 points away from the 145 strike. Now that could be for multiple reasons. There might be a good support at 140, or it might be just in a little bit of a more of a bullish pattern. That way we can raise up this lower vertical to be a little bit closer. That way we can collect a little bit more premium. So the price that we'll get for the 130 put is 3, the 135 put is 5, the 160 call is 3, and the 165 call is going to be 2. And the +1 and -1 is just letting you know what kind of transaction we are doing at those strikes. So we are buying this 130 strike put, we are selling this 135 strike put, we are selling the 160 call, and we are buying the 165 call. So to get our net premium, we will take in a credit of 1 with the bear call vertical, we will take in a credit of 2 for the bull put vertical, and then add those two together, we will get a net premium of 3. Then we can use that to calculate our break even by using the inside strikes and going out. So we will take the 135 strike minus the credit of 3. We will get the lower break even of 132. We will then take the 160 strike, add the 3. We will get a higher break even of 163. Anything between those break even points is going to be our profit, and then anything outside of those break even points is going to be our loss. Just to recap real quick. So the previous example where we were wanting it to move outside the range, you notice the strikes were close. That is typically what you want to do when you are expecting the stock to move outside of the range. You want that range to be as close as possible so that it can move outside of the range. For the sideways, you want the verticals to be a little bit further away. That way you have plenty of room for the stock to finish in between your break-even points. You want as wide area as possible, but not too wide to where you don't bring in enough premium. So it is kind of a delicate balance, but this is kind of what you were wanting to do. So if you appreciate these examples, give this video a like, and let me know in the comments if you have any stocks that you're going to be implementing this strategy on. Okay, let's look at some examples of the Condor and Iron Condor trade setup. So if you use thinkorswim or another platform where you can preload an order template, you can just right-click, buy, and in thinkorswim, there are 2 order types that you can utilize. You have the Condor or Iron Condor. The Condor is just going to load in, whichever call or put you were on. So it's going to load in all calls. You can switch it over to all puts. So you can definitely do that. And for thinkorswim, if you buy a Condor or Iron Condor, that's going to be the sideways movement, range-bound type of Condor. Okay, if you sell one, this is going to be you want it to move outside of a specific range, whether it's the upside or downside. Okay, but give me 1 second, and I'm going to load up each 4 legs individually. Okay, we are all set up here. So we have 1 point verticals. We have a bull call vertical and we have a bear call vertical. So we're just using a typical condor in this situation. And the price of the SPY, which is what the stock we're kind of looking at, is currently at 475. It is after hours, so it's not going to move around. So I kind of wanted to stagger away from 475 a little bit, but not too far. So you can see that this bull call vertical, we would pay out roughly 88 cents. And then this bear call vertical, we would bring in roughly 44 cents. So I think that would be like a net trade of about 44. So that would be right there, 44. So then our break even should be at 471.44, and it looks to be roughly close to that. And then 480.56, and it was kind of close to that as well. So what we can see here is we are expecting a range, or we have a range where we would like the stock to be at expiration, okay? And the options that we're looking at are about 5 weeks out, okay? So as we roll forward in time, what we can expect to see is the purple line just fills up and into the plateau, I guess, if you want to call it that. Okay, so that's what we're expecting for a sideways condor. So that is how a typical condor would look. Now, if we want to do an iron condor, what we can do is set up a bull put vertical. So what I'll do is I'll switch around these top two and make these a bull put vertical. So make that a put, make that a put, boom. And there you go. So yeah, the risk reward doesn't really change much. Changed a little bit, but it's not really that big of a deal. And so what we can see, I mean, it's still the same kind of setup. The risk reward won't change much. So if you're comfortable doing all calls, you're comfortable doing all puts, that's fine. I do prefer, in this kind of scenario, I do prefer doing the iron condor method, where you do a mixture of puts and calls, and I do prefer to sell them, but you don't have to. But if you want to see what a non-range bound condor looks like, well, we can set that up real quick. So I'll swap all these around. So there we go. I've swapped around the orders to where we now have a non-range bound iron condor setup. And obviously this is not good risk reward, so I definitely wouldn't do this trade. But you can definitely see how you're just expecting the profit outside of those areas in that kind of situation. And the number one thing, though, when you're doing these kinds of trades, the non-range bound trades, like if you're wanting to go up or down, is you definitely want to make sure the stock is moving and getting outside that range, and the sooner the better. That way it gives you a little bit of confidence. A tip, I guess, for you if you do this approach is, one of the things that's actually good to do is, if you put on this trade and you're unsure of which direction it'll go, and it goes a direction, well, you can definitely close out the other leg. So if it goes bullish, well, you can definitely close out the lower leg and get a little bit of your premium back. That way, you can increase your reward to risk a little bit. Okay, so that is another thing that you can definitely do, especially if you're in those situations where you're not really sure which way it's going to go. You put the trade on, it makes it move. You can close out the other side and recoup some of those gains, or some of that value. Okay. So if you need to brush up on some of the vertical strategies and stuff like that, click the video in the top left. Alrighty, take care, Alpha Hunters.